Buying a home is one of the biggest financial decisions most people will ever make. And when it comes to mortgages, one question creates endless debate. Should you choose a 15-year mortgage or a 30-year mortgage? Some people say the 15-year loan is smarter because you save huge amounts of interest. Others argue that the 30-year loan is better because the lower payment allows you to invest the difference. So which one actually builds more wealth? The answer is not as simple as many people think. Let's break it down using real numbers. Imagine you purchase a home worth $400,000. You put down 20%. That means you borrow $320,000 from the bank. Now let's compare two mortgage options, a 30-year mortgage with a 6.5% interest rate and a 15-year mortgage with a 6% interest rate. With the 30-year loan, the monthly payment would be about $2,023. With the 15-year loan, the payment jumps to roughly $2,700 per month. That's about $700 more every month. And this difference is why many buyers choose the 30-year mortgage. The lower payment feels safer. But what happens over the long term? If you keep the 30-year mortgage for the entire loan period, the total interest paid would be around $408,000. Yes, that means you would pay more in interest than the amount you borrowed. Now compare that to the 15-year mortgage. The total interest paid would be about $166,000. That means the 15-year mortgage saves roughly $240,000 in interest. That is a massive difference. So at this point, it looks like the 15-year mortgage clearly wins. But there is another perspective we need to consider: investing. Remember the $700 difference between the two monthly payments? Instead of paying that extra $700 to the bank, someone with a 30-year mortgage could invest that money. Let's say that $700 is invested every month into the stock market. Historically, the stock market has returned around 8% per year on average over long periods. If someone invested $700 per month for 30 years at an 8% return, the investment could grow to roughly $1,040,000. Suddenly, the picture changes. Instead of saving $240,000 in mortgage interest, you could potentially build over $1 million in investments. That's why many financial experts recommend the 30-year mortgage. It creates flexibility and allows you to invest more. But there is a very important assumption hidden in this argument. It assumes that the person actually invests the difference and that they invest consistently for decades. In reality, most people do not. Instead of investing the extra money, many people gradually increase their lifestyle. They buy nicer cars, eat out more often, upgrade their home, and the investment advantage disappears. But even if someone does invest the money consistently, there is another important factor that many finance discussions ignore: investment behavior. In theory, investing is simple, but in real life, it is extremely difficult for many people. Studies repeatedly show that the average investor significantly underperforms the market. Why? Because of human emotions. When markets fall sharply, many investors panic and sell at the worst possible time. During market booms, others become greedy and take excessive risks. Some chase trends, some buy high and sell low, others attempt day trading and lose money quickly. For example, during the 2008 financial crisis, many investors sold their investments near the bottom of the market. Those who stayed invested eventually recovered and made strong returns, but those who sold locked in their losses permanently. Another example is the cryptocurrency boom. Many investors rushed in when prices were skyrocketing, but when the market crashed, many lost significant amounts of money. Investing requires discipline, patience, and emotional control. Without those qualities, the expected investment advantage may never materialize. That's why the decision between a 15 and a 30-year mortgage is not purely mathematical. It is also psychological. The 15-year mortgage forces you to build equity quickly. It acts like a powerful forced saving system. Every month, more of your payment goes toward owning your home. After 15 years, the mortgage disappears completely. Your largest monthly expense is gone. This provides financial security and peace of mind. On the other hand, the 30-year mortgage provides flexibility. It allows you to invest, build liquidity, and manage cash flow more easily. But it requires discipline. If that discipline is missing, the benefits may never appear. So how do you decide which mortgage is better for you? Let's walk through a simple checklist. If you are highly disciplined with investing, if you consistently invest extra money every month, if you are comfortable with market fluctuations, and if you avoid emotional investment decisions, then the 30-year mortgage combined with investing may build more long-term wealth. But if you prefer simplicity, if you want to eliminate debt faster, if you tend to spend extra money rather than invest it, or if market volatility makes you uncomfortable, then the 15-year mortgage may be the better choice. Because the best financial strategy is not always the one with the highest theoretical return. It is the one you can consistently follow. At the end of the day, both mortgages can lead to financial success, but the key is understanding yourself, your discipline, your habits, and your comfort with risk.
Once you understand those things, the right mortgage choice becomes much clearer.
Once you understand those things, the right mortgage choice becomes much clearer. If you enjoyed this video and want simple explanations of finance concepts, make sure to like and subscribe to the channel, and let me know in the comments about the next topic.